Welcome everybody to another eye opener. This is Market Wealth Daily's quick little video chats that we do with top traders, and we've got Blane Markham here with us. Blane, great to see you. We love having you on here, and I am super stoked, everybody, because we've got a really uh, big day today. You guys have come up with something really exciting to me. It's super simple. It's place find a trade at the end of the day, and if I got this right, you place the trade, and by the next day it settles out and drops, the cash into your account. I mean, how much better can it get than that? That's just amazing. So let's jump into the overall market, but then we're going to kind of circle back. I want to see if we can have you give us a quick glance at that and tell us where we can get more information as well.
Yeah, absolutely. I'd be happy to do that. And first off, too, John, just excited to be here. Happy Wednesday to you. Thanks for having me here for today's eye opener. But yeah, definitely I want to touch on that before we get off today's call. But a lot of things going on in the market, so probably should go ahead and hop into those first. I'm sure folks have been watching the market from at home and seeing the really exciting trading action over the past couple of days. But John, I don't know if you checked your account lately, but we're back at all-time highs again. We just had our first close ever for the market. We had traded intraday on the S&P 500 above 6,400 several times. We had not closed above it, but yesterday the market blew the doors off of that. It raged past 6,400. In fact, closed almost all the way up near 6,450. It was just a massive up leg in the markets yesterday. And you can see that reflected there in the chart, but just a huge expansion over the past couple of days. So, yeah, I'm sure folks have seen that. I was excited about it. John, I'm sure you're probably pretty excited about it too.
Yeah, funny story. When I first started in the business, this is going way back into the 90s, and I used to go to conferences. Futures Magazine, which I don't even think is around anymore, used to do these conferences, Futures East, Futures West, and I remember, geez, I believe it was Larry Williams standing on the stage doing a presentation and talking about the Dow hitting 10,000 back then. And everybody laughed and thought he was crazy. And they're like, no, that's
Yeah.
not whacking. But and here we are with the S&P over 6,400. Like, just amazing to see these kind of levels. What a testament to just this market in the way the market operates. Really a useful tool, really helping out a lot of people. And hopefully we can find out ways that it can help out everybody who's kind of watching us now.
100%. Yeah, no, it's just really impressive. Just I think in modern times, the world is just ever getting noisier and noisier, and there's just so much and so many headlines and so many things telling you why stocks shouldn't be working. But then you look at the chart and you see that we're printing new all-time highs yet again today, intraday. That the market, by and large, most of those things don't matter in stock market land. Of course, sometimes eventually those negative headlines can add up, and they eventually do. But there's really key things that the market is cued in on, and a lot of those have started falling in the way of the market. We've seen earnings from the last quarter in Q2. It was substantially better than what most had feared, and we had really great beat rates on the earnings in the S&P 500 stocks. So Q2 earnings came in really strong. We are now, we just got another fresh inflation report yesterday with the CPI for July. Came in a little cooler than anticipated. That was a major tailwind and reason why stocks rallied so much yesterday, which I don't want to bury the lead. We're going to get into that a little bit more here in a second. But, you're starting to see a lot of these things start to fall in favor of stocks. It's going to be supportive to equities begin to trade higher. And so that's exactly what we're seeing. But, John, we saw that pullback. We had said, for quite some time, the market's just gone nowhere but straight up for almost a month. We were saying that for most of July. And of course, we also kind of cliff noted that, saying that can go on for quite some time. Stocks can remain in temporarily overbought status for a little bit longer than you may think, but eventually you do have to have prices come in a bit. People are going to take profits. There's going to be something that comes along that spooks some folks out of the market. It's going to cause
Mhm.
that dip, And it was really important to see what happened following that dip. Of course, we had that dip occur right here a couple weeks back. But what was really significant is the market action since that dip, and it's been abundantly clear that the market is still of the mindset that investors, broadly speaking, are looking to buy these dips when they occur. They're still very much of that mindset. They're still very bullish on stocks, looking to be very opportunistic, and that's the only explanation for the trading action we've seen, at least at the index level, since that dip that we had, to really start the month. We traded, fell back below the middle Keltner channel, had some really choppy trading for about 4 days there. It was looking a little, like, oh, it could kind of go either way here. But then buyers came swarming back to the markets. The trends stayed fully intact. They still are today. The long, short, medium, and long-term trends all still look fantastic. Momentum starting to reaccelerate. That's, of course, evidenced by the new short-term series of higher highs and higher lows, of course, breaking out to new all-time highs. So you're seeing that on the chart there. And then again, if you look at the RSI chart down here below too, John, seeing that line spike up the way that it has over the past couple of weeks, where that is and where the index price is trading now, you're getting back into that, a little overextended camp. But nonetheless, each of these charts here are signaling very strong momentum, a really strong uptick in velocity to the upside. So that's exactly what we like to see in a strong bull market.
Yeah, absolutely. Here's something that I noticed today. I look at the index in the morning, and as my eyes are starting to actually open up, and I'm not so sound asleep at my desk, the VIX is cooling off. And if what people might forget about the VIX, everybody knows that if you don't know, it's a measure of volatility. But the way it's calculated is based on futures positions. It is traders' expectation of what they think volatility will be in the future. Not very direct. It's not what volatility is right now. Is the market going up or down? It's what people expect. And when that cools off, you have traders feeling like this is going to be stable. Add on top of that, that you have the very high likelihood of a rate cut, or I won't say high likelihood, but the discussions of a rate cut being discussed, and the market being optimistic that you will see a rate cut. This gives you the sign that, all right, everybody's expecting it to keep going up. There's signs that will potentially keep it going up. It all supports what we're seeing on the charts, and the charts are objective. Tone out the headlines, shut off the news, look at the chart. I mean, you
Yep.
can't completely ignore it, but you really just, the charts don't lie.
Yeah, exactly. You have to, what helps me a lot in trading the markets is really having the ability to compartmentalize, whatever could be personal beliefs and, whatever news you're watching, whatever it is, but segment all that over here. And then in this bucket, you need to be paying attention to the market and what matters to the market. There's a lot
Mhm.
of concerns out there, a lot of headlines, a lot of noise, but only a certain number of things, really have any bearing on markets and stock prices. And, when you have your stock market trader hat on, those are the things you need to be concerned with. And as you said, looking at the charts, looking at the technicals, that's one of the really key ones. In the short to medium term, particularly, technicals have a substantial weight regarding performance over the long run. They really
Mhm.
dictate a lot of trading in the short to medium term. And just from an outlook on the market, John, I know we're looking, into August, September now. Historically, they have been, fairly choppy periods for the markets. Again, historically, two of the worst performing months for the market. So, generally have gotten some, choppy trading in these 2 months. It doesn't guarantee or mean that that's what's going to happen this year. But, just from the current outlook, we're by and large completely done with Q2 earnings season. We have a few outstanding reports that are important left, but vast majority of S&P 500 stocks, over 90% of them have already reported earnings for Q2. The earnings reports, the beat rate was good. Earnings growth rates were good. The technicals on the chart look really good. And as you said, John, the evidence for the camp that is hoping for a rate cut and lobbying for a rate cut is only growing, particularly after the last jobs report and the most recent cooler inflation report. So we're starting to see now the odds of a series of rate cuts starting to tick up. So with all of that as the backdrop, it makes sense that stocks are rallying, right? Those are all of the things that work together. That's the formula to make stocks want to rally. Seeing, rates drop, earnings growth good, earnings estimates beat, and the technical strong. That's kind of checking almost every single box. Of course, it could be as soon as I say that, then we start to get some of the seasonality chop starting.
Well, yeah.
So maybe that would be my luck, but it's a pretty nice backdrop considering all those factors.
No, absolutely. So the thing to keep in mind here is if we've learned anything since the beginning of the year, the rules don't apply as much as they have in the past. So, when I say the rules, I should be more specific. The seasonality, things like that, seem to be not as concrete as they have been in the past. There's a lot of kind of growth happening in the markets. And when you're growing, you're vulnerable, things are changing, they're different. Tariffs are the absolute perfect example. The first mention of tariffs getting implemented, look what happened. The market absolutely tanked. Now, they're talking about tariffs every day and people aren't even blinking at it. So, the markets will tell you it's very important to be aware of what those seasonal trends look like. Know what signs will be on the charts to show you that the seasonal trend is playing out and also know what signs to look for that the seasonal trend it's going to do the opposite of the seasonal trend because that is also possible. The chart will tell you. Look at the chart. It'll tell you what the market following that seasonal trend? Is it not? Right? Is the intermarket rotation following the typical pattern? Is it breaking the rule? The charts will tell you all these things if you look at them.
Exactly right. And just to speak to your point there, John, that a lot of that seasonality, doesn't necessarily hold up every single time. I mean, there's another great example of it right in this chart right here. What does everybody like to say as soon as we're approaching May, coming out of spring? Everybody likes to say, oh, the old adage was sell in May and go away.
Right.
Look at this chart right here. You would have missed out on one of the greatest V-shaped recoveries in the stock market that's ever happened had you
Hmm.
followed that seasonal tip there. So,
Yeah.
it's good to
Uh,
put it in
How
perspective with that.
Yeah, how many people are trading in the market? I mean, you can't use an adage. It just doesn't work. There's too many humans involved and it's too complex. Adages are a good place to start, but then you got to confirm them. So, yeah.
Exactly. But all that, I think it's a, good segue, John. We were talking about kind of the backdrop in the markets and, what has investors so bullish, so eager to buy those dips when they occur. And one of the things I want to talk about is this next chart I'm pulling up right here. So this is one, people probably don't look at this on a chart all that much. Um, but what this is actually, this is a, chart representation of the 10-year US Treasuries yield. And while we're looking at this, this is a, very important thing to track for the markets. And what you can see here is that pretty much since that high we made in May, right here, we've been making a gradual series of lower lows and lower highs. You can see that overall, if you were to draw just a kind of a midpoint line through all of these data points here, all these close prices, we would have a down sloping line. And you can see it looks like we're, beginning to take another leg lower here in the 10-year US Treasury yield. Why this is so important for markets, this is one of the best proxies for long-term borrowing rates. So whether this is for consumers, whether it's the consumer going out looking for a mortgage, this is one of the main proxies that helps to price interest rates for consumer borrowing, even for a lot of business lending as well too. So when you start to see this yield start ticking down, that means that interest rates are also going to eventually follow it down too, because that's just how these things are priced. They're obviously not exactly the same, but this is the proxy for the direction of which those interest rates are going to be moving. You can see this starting to move down. That's the market telling you, that interest rates are likely set to start moving lower here soon. And another just confirmation of that, this is a great tool to watch. This is totally different. This is from the CME group, but it's their Fed Watch tool. And they kind of take a lot of the guesswork and having to do the math yourself if you're just trying to calculate this using Fed funds futures. But that's how these numbers are calculated. And what it is showing you the probability of what the market is pricing in for the probability of rate cuts at each of the upcoming Fed's meetings. So, you see the 10-year U.S. Treasury yield declining. That's going to be, signaling that interest rates are going to be coming down on the long term, the long end. Here, we're looking at the Fed funds rate. So, you can see right here that our current range, this is obviously the range the Fed funds rate is in currently. You can see that the market is currently pricing in for the Fed's upcoming meeting in September, so mid-September, about a month away from today. It's now factoring in a 99.9% probability that the Fed is going to cut rates by 25 basis points at the upcoming meeting. That's, of course, shown by this bar here, and that's been substantially increasing. You can see a month ago down here, you can look back, it was less than 60% being priced in. And it's just kind of rocketed higher in the last couple of weeks. It's now, all but guaranteeing is what the market is saying, that the Fed is actually going to be cutting rates. And if you go out through the end of the year, of course, we have 3 meetings, John, for the Fed through the end of the year, September, October, and December. It's actually now pricing in and showing a probability that the market is expecting 1 cut at each of those 3 meetings for the rest of the year. So, when you start to, digest that, portend that out to what that means for, actual interest rates in the economy for, consumer and business borrowing costs, that eventually is going to start feeding in bringing those borrowing costs down, which of course is stimulative for the economy, stimulative for the consumer and business. It's lowering their cost of consuming or doing business. So, with that in mind, we have a backdrop where it looks like interest rates are going to finally start coming down in a meaningful way, likely in the upcoming back half of the year. So, John, that's how I landed on my trade for today. This is a very kind of tactical setup, understanding what's going on with the interest rate market, the Treasury market, seeing those yields drop in anticipation of rate cuts coming. And so that's how I landed on this trade right here. It's for Zillow Group. Most folks are probably pretty familiar with what Zillow Group is. If you've been out ever looking at a house, home ad online, or maybe even looking to rent an apartment. But of course, they're an online marketplace for renting or selling or purchasing homes. So you go in there, you can see all the lists, listings of, home ads, apartments. It's a marketplace for that. So of course, their business is significantly interest rate sensitive. When you start seeing interest rates spike up, of course, that's the stocks like this are going to take a massive hit, and they're really going to take it on the chin because as we've seen in the past couple of years, even though home prices have remained elevated, they haven't really come down that much. Nationwide speaking, the rate of sales that faucet is almost completely turned off. But when you start seeing interest rates come down, you're going to see stocks like this start to rally because people are going to be anticipating that the number of deals, the volume of sales is going to start picking up, which is going to be a tailwind to Zillow's business. So you're starting to see that translate, John, into the price action for Zillow here. You can see, looking at the past 6 months right here, stock bottomed out along with the market in April. It consolidated, sideways for the subsequent 2 months there. You can see in May and June, it really just kind of traded sideways, stuck in neutral. But as those, hopes and anticipations for the market, that rate cuts were coming, we started to have some data come in, saying that was very likely to happen later in the year at the remaining Fed meetings. Starting to see the 10-year U.S. Treasury yield start to move down, over the past couple of months as well. You can see the stock started to get a bit of a lift here. And when it started to break out, here is when our technical buy signal, it's one of my favorite ones to follow. It's looking at the 21-day EMA. That's our red line on the chart there. And then also the 63-day EMA, that's our green line. We can see that we had a breakout in the stock. The technical trend followed there shortly after. You can see we had a breakout right here towards the back half of June. And ever since then, the distance between those two EMAs has begun widening out. And the stock's been making a very pretty series of higher highs and higher lows. It looks like it's still pretty early in the breakout for this stock, but really constructive trading. You can see recently the stock was actually trading at 6 months highs, trading outside of the upper Keltner channels on several occasions. But it has cooled off. It's come in a little bit. It's trading, it was actually touched the middle Keltner channel today, John. So this is signaling that it's, certainly not overbought according to the technicals in the short term at these current prices, currently trading about $82 a share. And we're seeing the same thing down here on our RSI chart too. This is a 5-day RSI. We can see the RSI line is spiking, so that's indicating ramp up in momentum behind the stock. But it's also trading above 50, so that's a bullish sign according to that RSI. But again, it's not trading above that level of 70. So that's signaling again that despite the nice trend it's broken out on recently, Zillow is not currently overbought at current prices. So this is looking like a very, very attractive trade setup, given the current backdrop, that likely the interest rates could be moving down. And so the way I want to target this one, John, is I was actually going to go ahead and look at setting up an in-the-money call option debit spread. So Zillow, they've already reported their earnings that, they reported about a week and a half ago. Don't have to have that, upcoming earnings report as a concern, out there. So I looked at the September 19th option expiration, and I landed on this 5-point spread right here, specifically looking at the 72.5 call and also the 77.5 call. So be looking to buy to open the 72.5 and sell to open the 77.5 call. And you can see, I'm just going to go ahead, put one in here. And you see the midpoint for the spread's currently coming in just about 4 points. I would look, since this is a 5-point spread, John, I'd look to get in at 4 points or less just to guarantee that my trade has at least a 25% profit potential. But I'm just going to go ahead and put a limit order in at 4 points for this debit spread, and go ahead and submit that, see if I can get it filled. It's a decently tight bid-ask spread there. But I was really excited when that chart popped up on my screen today. I found that set up, and I was like, "Yep, this is this is definitely the one I'm going with in the eye opener call."
Oh yeah, no, perfect. Yeah, it completely tracks. Makes a lot of sense. Interesting. If you think about it, Zillow is probably a lagger behind rates. So, like as you get news that rates are going up, it's not going to tell you that rates are going up, but as soon as you get a whiff that rates are, Zillow is going to
Mhm.
respond to that. So, great way to, great job spotting this one. This is a really good opportunity here.
Yeah, yeah, it looks like, kind of an early breakout in progress. It's only been in this uptrend for, a little over a month. And, if we start going into, a rate cutting cycle, the market, at least at, current pricing, looking at the Fed, CME Fed Watch tool, it's anticipating we're going to get 3 subsequent or consecutive rather rate cuts at the upcoming 3 meetings to close out the year. So if we actually do get a rate cutting cycle, we still continue to see those long-term yields come down too. That's really going to put pressure to the downside on interest rates and mortgage borrowing costs, which is going to be a massive tailwind to a business like this. So, if that plays out how the market's anticipating, this one probably still has a good bit of room to run to the upside.
Oh, that's awesome. That's amazing. That's really good. Uh, we're definitely going to keep an eye on this one. Also excited, Blaine, about the project that you guys have been working on recently. The everyday income strategy that I've seen a lot about. I've seen the presentations. I am totally locked into this thing. I love the concept. Whenever you can simplify trading this much and just kind of really have something that is shown this kind of success, I love it. And I'm a big fan of these approaches that, you do it and then you stop thinking about it and they keep winning. That's a big thing that we're interested in. And I know that there's been a lot of information you guys have shared this week about it. Wonder if you could just give us a very quick Reader's Digest version on that, and then we can maybe share some places where people can get more information.
Yeah, 100%. Yeah. So yeah, exactly. The everyday income alerts, it's a brand new trading strategy. It's unlike anything that we've ever done before. It's a completely different setup, completely different strategy. And it's really unique, John, because it has, like you said, it's very high frequency. It's a strategy that is designed to spot a trade setup every single day. It's one that's going to be entered near the close of the trading session. And the idea is that you'd be looking to exit that trade shortly thereafter, in the following trading day once the market opens. And the trade, it's, in addition to be, a nice high frequency trade, it has the ability, the trade itself, to profit whether the stock remains flat, increases a bit, or even decreases a bit. So it has some nice wiggle room in there depending on what the underlying does. So it has some
Mhm.
really neat features to it. And on top of that too, it's very low cost. The average cost for per position on this trade comes in, about on average about $240, if you were just to trade one contract of it. So it's a really unique strategy, high frequency, low cost, and even better yet, John, in real time trading, our team, we've been trading it here really actively for the last 3 months, heading into being able to launch this, get this in the hands of our customers. And in the real time trading, we are actually able to hit wins at a rate near 80%. It was like, I think, 78.9%. So it was right at 80%, just about, on a win rate. So, just about 80% of the time, these, everyday trades, in the past 3 months, we were able to lock in wins. So, of course, we're not going to win every single trade. Of course, we all know past performance doesn't guarantee future success. We all know that, right? But being able to see an everyday strategy with a win rate, approaching 80, that was really impressive to us. And so we were super excited to get this out there to the customers so they can check it out themselves.
So here's the question that I have about it, because this, I know, again, we have traders all different levels, and you're placing trades every day, right? So if I'm an active trader, I'm placing a trade every day, and you're out the next day, right? And you've got 80% win rate. So that means 80% of the time you're making money on that. Isn't that a risk of getting caught by the day trading rules, and that you could be flagged as a day trader?
Yeah, so it was very strategically designed in the way that we do it. So since if you look at how those pattern day trader rules are written, the if the trade is entered and closed within the same trading day, that's what flags as it a PDT trade. So the way this is set up, you're entering at the close. Say if we were looking today, we would enter near the close today, and then for that same trade, we would not be looking to exit that trade until tomorrow. So, we're looking to enter this trade with just minutes before the closing bell rings today. So you're really only holding it for a matter of minutes today, and then holding it overnight into tomorrow's trading session, and then closing tomorrow. With it set up that way, very strategically, that completely sidesteps all those restrictions on the pattern day trading, so that those trades will not get flagged as PDT trades in your account.
Yeah, and I can't remember. Geez, I'm going to owe somebody an apology, but I remember talking with someone. They were explaining that if you look at the trend that the S&P has been on, like if you took all the gaps out, it would be almost flat, if not flat, but almost flat. As opposed, most of the gains have been overnight, gap up type moves, and just makes this make even more sense. That is just a great
Right.
trading approach to exploit that pattern. We just talked about it earlier. Charts don't lie. If you see patterns happening constantly and there's that significant of an impact on the market, figure out a way to exploit it. And it sounds like you guys have done exactly that. So,
Right. Yeah, exactly. That's what the strategy was designed to do, because we did historical testing, to figure out what the average move for the S&P 500 is on any given day. Of course, we're looking at a huge sum of data over multiple years, but just trying to figure out what the average daily move, whether up or down, is. And it turned out that the average move on any given day was less than 0.4%, whether up or down. So, you may not realize that, but on any given day, that we're not seeing, of course we get days like we've had yesterday and today, we're breaking out to new all-time highs, and you get those, big gap days and, just massively bullish days. Of course that happens, but your average trading day, it's a smaller move. It's usually more of a grind higher or grind lower, just kind of gradually, eking out moves and having those smaller, day-to-day moves. So that is what the strategy is designed to target. And it's been very diligent and set up. It's, again, like I said, the average daily move, whether up or down, is less than 0.4% on the S&P 500. So this system was designed to exploit exactly that.
Wow. Well, all right. We're going to put the link in there. If you're in the room, you can grab it in the chat right now. So we want to get this out to everybody right away. If you're watching the replay in the email that you access the replay, we are going to put the link there as well, so you can get in on this. And I know that there's it's a great introductory offer. So definitely click on that link and check it out. We want you to be able to make up your own mind on it. There's a lot more information available for you to figure out if this is right for you. I can't imagine that it wouldn't be, but you make the decision. We got smart people in our audience, that's for sure. So we'll share that. Blane, thanks so much. This is a lot today. Really appreciate you kind of doing the marathon chat with us. This one went long for sure.
For sure, yeah, yeah. We weren't able to get together on Monday, so I had a lot of things saved up that I wanted to share today. So had to make sure we could fit it all in. But I appreciate the chance to be here, John. Appreciate the time. Always love getting to sit down and do these chats with you, and hope folks enjoyed it. And also hope they click the link below to check out the Everyday Income Alerts program. Check it out, see what it's all about, find out for yourself. I think you really enjoy it. But hope you enjoyed today's call. And John, I'll see you back here next week, I guess.
Yeah, we'll be back on Monday for sure. If you're not on our Telegram channel, we'll put a link to that in the email as well, so that you can be on there, and make sure that you get invites to all these sessions, right? And reminders as they're coming up. So we want to see you in here. We want all the questions that you have to throw at us, stump us, give us a hard time, rattle our cage, whatever it is, just jump in these sessions with us. So we will talk to you guys all soon. Thanks again, Blane. Take care.
Take care, John. Thanks so much.